Welcome to this lecture on personal finance, focusing on home mortgages and renting. This is one of the most significant financial decisions individuals make, carrying unique financial responsibilities, risks, and opportunities. Our learning objectives today include understanding the advantages and disadvantages of renting and owning, learning how mortgage loans work, and evaluating factors that determine whether to rent or buy. Renting offers flexibility, minimal maintenance responsibility, and lower upfront costs. However, rent payments do not build equity or ownership over time. The advantages of renting include the flexibility to move easily, no responsibility for property maintenance or taxes, and lower upfront costs like a security deposit instead of a large down payment. Conversely, the disadvantages of renting are no equity accumulation, being subject to rent increases or landlord decisions, and limited control over property customization. For example, a student renting an apartment for $1,200 per month pays $14,400 in a year but owns no portion of the property. Renting makes sense for short-term flexibility, but not for long-term wealth building. Homeownership, on the other hand, builds long-term wealth through equity and potential property appreciation, but it requires significant financial commitment. The advantages of owning include building equity over time as the mortgage is paid down, potential tax deductions for mortgage interest and property taxes, and stability in monthly housing costs with fixed-rate loans. However, owning also has disadvantages. It requires a down payment and closing costs, maintenance and property taxes add ongoing expenses, and housing market declines can reduce home value. For instance, buying a $250,000 home with a $50,000 down payment means borrowing $200,000. As payments are made, homeowners gradually build more equity. Now let's delve into how mortgages work. A mortgage is a long-term loan used to purchase real estate, with the property serving as collateral. Key components of a mortgage include the principal, which is the amount borrowed, interest, the cost of borrowing, the term, the length of the loan, usually 15 or 30 years, and the down payment, an upfront payment reducing the loan amount. Consider borrowing $200,000 at 6% annual interest for 30 years. This results in a monthly payment of about $1,199, but total payments over the life of the loan exceed $431,000, dramatically increasing the total cost due to interest. Mortgages come in two main types: fixed rate and adjustable rate mortgages. A fixed-rate mortgage maintains a constant interest rate throughout the loan term, ensuring predictable payments. An adjustable-rate mortgage has an interest rate that changes periodically after an initial fixed period. While often starting lower, adjustable-rate mortgages carry the risk of future increases. For example, a 30-year fixed-rate mortgage at 6% remains constant. An adjustable rate mortgage might start at 4% for 5 years, then adjust annually, potentially rising to 7 to 8%. The decision between renting and buying depends on a combination of financial, personal, and lifestyle factors. Factors to consider include how long you plan to stay in one place, the availability of savings for a down payment, your credit score and ability to qualify for a mortgage, and local housing market conditions. If renting costs $1,200 per month and buying costs $1,500 per month, including taxes and maintenance, but the homeowner gains $4,000 in annual equity, buying may be better after several years. Lenders assess risk by examining the borrower's credit score, income, and debt-to-income ratio to determine mortgage qualification. Typical requirements include a minimum credit score of 620 for conventional loans or 580 for FHA loans, a down payment of 3 to 20% depending on the loan type, and a debt-to-income ratio ideally under 36%. For example, a borrower with $4,000 monthly income and $1,200 in debt payments has a debt-to-income ratio of 30%, which is within lender guidelines. Beyond the mortgage payment, homeowners must budget for additional ongoing costs. These expenses include property taxes, homeowners insurance, maintenance and repairs, and homeowners association or HOA fees. For a $250,000 home, if annual property tax is $3,000 and maintenance averages 1% of home value per year, it could cost an extra $5,500 annually beyond the mortgage. In summary, renting provides short-term flexibility, while buying offers long-term financial benefits through equity. Understanding mortgage terms, credit, and costs helps make an informed decision. Key takeaways are that mortgages combine principal and interest, often doubling the total cost over time. Renting suits those seeking mobility or short stays. Buying is ideal for long-term residence and wealth accumulation. We encourage you to compare renting and buying options locally using online calculators to estimate break-even points. Thank you for watching this video on home mortgage and renting. We hope this information helps you make smarter, informed decisions.